Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Getting stuck in the property, everyone's talking about it at the moment. You only need to sort of go through your social media feed and, occasionally jump on there, and obviously it's algorithm orientated, so knows I'm interested in property. It keeps serving me up a whole bunch of property information. A fair bit of misinformation around at the moment around property investment, I think. It's sort of, if you're a student of this sort of stuff, misinformation or disinformation. Well, disinformation is where people deliberately give incorrect information. Misinformation is normally when people accept an information and think it's factual and keep propagating it, and that's misinformation. So not deliberate, but you see a lot of people propagating particular things around social media at the moment when it comes to property. A lot of it is a bit alarmist. A lot of it is quite nonsensical in property. So just be careful where you get your info around property investment. The fact that you're tuning into this show, I'd like to think this is a sensible source of commentary and discussion in property investment. We've had 10 million downloads of the show, so I'd like to think that gives some sense to we're doing something right. But please keep the feedback coming. We do enjoy it. We like to keep changing and shaping this show, this discussion, to help people make more informed investment decisions. But not everything, believe it or not, newsflash, not everything you hear on social media is factual and truthful. And often a lot of people have an agenda there. So just be careful. Question everything. Speak to the right people when it comes to property investment if you're going to make a decision. And you need to remember there's a whole bunch of people that can help you investing in property. Your accountant, for example, normally a pretty good start. Mortgage brokers, buyers agents. I'm going to chat with a buyer's agent today to get a sense for how he's seeing the world and all and sundry. So it comes always back to you exactly your responsibilities investing in property and the accountability around property investment. So make sure you invest with the right information would be my decision. But a lot of people's property journeys start and stop at different times. Some people start early, some people start later in life. That can shape your decision-making process. If you've got time on your side, it can be a lot more forgiving in terms of choosing the wrong assets and trying to fix it up. If you start property investment later on in life, you've got to make sure you get your decisions even more crystallised and get the right ones. Again, these professionals I spoke about can help you out with it. But we don't normally chat a lot about it because it's just an assumed knowledge. But I think it'd be a good opportunity to actually get a sense for the stages of property investment. This is very much what I wanted to chat about today. The theme of today's conversation is that, what is the basic structure for how people invest in property, and to summarise them is the accumulation phase. It's when you sort of start buying properties, and that will go for a period of time. And then you have a consolidation phase. Typically, it's when you probably don't buy at the same speed that you had, and you start looking at finessing and tinkering your portfolio. Then you enter a retirement phase. And that's when you start drawing down on those assets that you built. Pretty simple stuff. However, there's a lot of information inside of it that if you get right, you can make sure for as long as your investing journey is, you can make the right decisions. Joining me in the studio to have a chat about this, George Cherchian. He's from a relatively new business, and I'm quite keen to hear more about it over the time. He's a licensed real estate agent. He's a buyer's agent. He's a mortgage broker, financial planner. So he's done all this stuff. I don't think he does too much of that, but he's very aware of it. He's from a company called James Chase Buyers Agency. Join him in the studio, also online. Welcome, everyone. George, how you going?
I'm very well, Phil. Thank you. Thank you for having me.
No, mate, it's good to see you, and I think we have a common accountant is what I would call it. And I'm pretty protective of my accountant because I don't want him getting too much work because I want him to prioritise me. That's not always the case, and I get that. He's a pretty in-demand guy, and he's been on the podcast before, Munzrul Khan.
Absolutely.
There's a lot of property investors that use Munzrul these days, and he keeps an eye on your portfolio, does he, as well?
Definitely does, mate. He's very much a valued strategic partner for us. Looks after the business, looks after our clients. So great to have him on board.
Yeah. What do you like most about Munzrul? What do you like most about Munzrul Day?
But I think he's got his finger on the pulse. He's a wealth of knowledge. He's a voice of reason and also a calming one as well. So very much a good confidant and a mentor.
Yeah, he gives a good sense for calmness, and you can't call him no. He's too busy. Don't call him. You're not allowed to have him. He's our accountant, but I no doubt, Munzrel, you're tuning into this, mate. I say that in jest. I hope you're well, and again, thanks for all your help, sort of helping me shape the portfolio. We're actually going through a bit of a process now, selling down some assets, which I'll share on the Smart Point Investment Show, which my accountant is right across. But thanks for the intro, Munz, into George. It sounds as though he's building a pretty good buyers advocacy business. But George, give me a sense for that, because I mentioned you've been in and around property for 20 odd years. You're a real estate agent, qualified as a mortgage broker and a financial planner, but you've chosen to be a buyer's agent. Why?
Absolutely. So I guess it really goes back to when I started out in the workforce myself. In my late teens, early 20s, I always gravitated towards property as a form of asset class that I'd want to invest in. But I found the people around me who had done quite well were relatively cagey around the keys to their success and, the path they'd walked to get to where they were that day. So for me, that goes completely against my sort of train of thought. If I know something that can help you succeed, then I'm an open book, right? I'm more than happy to share what I've learned to help you get ahead as well. So I think subconsciously over the years, that's really sort of, played in and led me to where I am today.
Are you happy where you are?
Very much so. I love property and being able to work in the space is rewarding, so it doesn't really feel like work.
That's probably a good place to be. They reckon that if you feel as though you're not working, you get a lot more satisfaction out of what was before. How long's the business been going? James Chase Buyers Advocacy.
So we've just ticked over 12 months.
Okay.
So it was born through the COVID era. But prior to that, I've been in the property space for about 20 years, predominantly in the commercial space. So looking after assets, making sure they run optimally, both, I guess, on the balance sheet as well as operationally. And then towards the later end of that 20-year span, I've had exposure as a property manager as well. So completely sort of in the commercial space. But given I've been sort of numbers focused, orientated, and an investor in my own personal space, and something I enjoy doing, it ticked quite a few of the boxes, so I made the transition over. Yeah,
and it's probably not a bad apprenticeship, 20 years of it, working inside of commercial property, because the way in which asset managers, commercial asset managers view commercial property is very, the discipline of the numbers and the discipline of performance across different areas and metrics that can be recorded. It's a really good discipline that you can take into residential property, isn't it?
Absolutely. A lot of the skill sets are transferable, and you approach things with a commercial view, and it does keep you disciplined, as you've said. So it's definitely helped.
Yeah, and I think you're personally investing in resi property now. Do you hope you get back in commercial at some point?
I do. It's part of my long-term strategy, to be honest. So it's definitely on the cards.
Yeah. And why commercial over resi, do you think?
For me, a level of it is familiarity. So having operated in that space for a couple of decades, it seems like a natural transition. And also, I guess, as my own sort of personal property investment journey matures and advances, I find that it's going to be more of an efficient form of investment for me.
Yeah, and this is about getting good utility out of the bucks you put into property. And you typically find, and no doubt, George, you see it in some of the clients you're working with, in where people start off in resi property because it's a little bit more accessible from a price point of view, and also a lending point of view. Most commercial lending, you need to put more dough in than a residential. But I think all resi properties, or good resi property investors, normally sort of, move to commercial property at a point in time as they go down their journey of investing in property, and we'll sort of chat a little bit about those different pillars of it today. What just general at the moment with commercial property, what do you like? Sort of industrial, sort of office, retail? Where's your preferences? What's working?
So at the moment, industrial is something I like, with also retail as well. The commercial's still a bit hit and miss. I think there's a whole return to office push, which is a bit of an arm wrestle at the moment. I think eventually one side will win, and that market will bounce back. But typically sort of industrial type assets are where a lot of the interest is at the moment.
Yeah, and that really sort of surged through the COVID period where there was a lot more logistics orientated businesses delivering packages and services and products into Australian homes, and that really has continued. There's a huge amount. I don't know if you've noticed. There's a huge amount of I'm seeing, maybe because I'm just interested in it. It's like that red car thing. You see red car everywhere, but a lot of new industrial parks being created all over the place on the outskirts of Sydney. You must be noticing that as well.
Definitely, because there's a very high demand. Recently, I worked with someone who had quite a strict brief in this space, and ultimately the type of asset that they were after just didn't exist, right? So that's where I think the development comes in, because there's definitely a demand for it. And to your point around some of the international operators who are, sending goods to consumers directly, they're also acquiring a lot of this space as well. Between them, data center operators and what have you. So I know of a particular asset in Huntingwood recently that got absorbed again by someone looking for that sort of logistical space. So it's definitely an area that is in demand with short supply.
Are you doing much commercial buyers agency work, or are you mainly resi with your new business?
So mainly resi at this stage. The plan is sort of long term to offer that, but I think we want to focus on the residential for now, make sure that that's sort of serving our clients and the pipeline that we have well to the level that we want it to. And then it's something, given the background that I have, I think I'll explore.
Into it. And back when you're doing sort of more corporate asset management stuff inside a commercial, was it mainly retail or industrial, or is it sort of office?
So over the years, it was mainly retail and office, so commercial space. The industrial exposure was quite minimal, but typically, so your offices, retail space, that sort of thing.
Is that like big, large stuff owned by super funds?
More sort of ASX listed companies, to be honest, like whether it's sort of banks or other government organisations that have a large residential footprint, a large property footprint, and the portfolio would be a bit of a hybrid, right? So you'd have the commercial, the retail, and then there'd be a small amount of resi peppered in there somewhere as well. So it was around managing their portfolio. And looking after their needs. Yeah,
and two different beasts, retail and office-based stuff, isn't it?
Very much so, very much so. Two different sort of approaches, two different learnings, and it's good to be able to sort of, I'm glad that I've been able to cover both and get the understanding across both asset classes.
And tell me about, because I find this really curious, what was the inflection point when you went, no, I'm going to go and set up my own buyers advocacy? What was the origin story with that? It must be one thing.
Very much so. So typically in the space that I worked in my corporate time, you're an outsourced provider, right? So we were in the thick of the pandemic, very early stages though, and we knew sort of where it was headed. And I looked at that and I thought, you're sort of not in control of your destiny there, given the space I operate in and the way you get remunerated. So it was a crossroads moment, and I thought this is an opportunity for me to look at what I'm doing, what I'd like to be doing, and connect the dots. So I used that time, the time where we were, I guess, sort of contained in our dwellings, to upskill, get my qualifications, and firm up a plan. And fast forward sort of 12, 18 months, here we are.
Tell me about your first day as a buyer's advocate. What did you do?
The very first day, to be honest, stuff in hindsight that I probably shouldn't have been doing, just making sure the website's right, making sure the email's working, the phone's right, the social media's working. But in retrospect, the first day probably would have been or should have been ringing up and trying to secure my first bunch of clients and business to business relationships.
Yeah, hindsight's a great thing, and look, I think everyone probably does that, right? Most buyers agents, that's typically their first day, but you got to think of what the inherent capability of a buyer's agent is. And I speak to a lot of buyer's agents, George, and I'd like to think Smart Property Investment would have been a great enabler for promoting the capabilities of buyer's agents. They act on behalf of the client to secure the best assets for the right reason, with the right outcomes, with the right strategic approach. And you see more and more Australians turning to buyers agents to support them, because it's pretty hard, right? Particularly in markets with a lot of disruption in it, which I would sort of say is today. What's been any memorable moments as a buyer's agent? Yeah, what are you most? You're only 1 year in. Anything that really stands out for you?
There's been a few, but I think the more recent one is working with a client who wanted a positively geared property. So I do have to say that they're a cash buyer, so that part was pretty easy. But in terms of sort of giving them value, we identified a property which was being rented out for significantly less than market value. And we were able to factor that into our negotiation and the purchase price that we ultimately agreed to. We were fortunate in that the market we bought in was quite hot, heavily sort of contested. So a lot of demand in that area. But not many, I guess, investors were in the same position we were in, where we were able to sort of, the client I was working with was able to withstand the lower rental income coming in and absorb it. But then obviously knowing at the end of the 12-month rental agreement, they'd be able to bring it back in line to market. So that was quite good to be able to identify those sorts of opportunities and then ultimately use that to negotiate a lower purchase price for the client too.
It's a really good point. A lot of people get absorbed in investing in property where they only think about the prospects for capital growth or the ability to buy a property, inverted commas, under market value. Again, it's inherently connected with capital growth or its capital appeal, but there's this whole cash flow component of it as well. So, this view or eye towards value is not just around capital growth; it can also be around cash flow and yield. So the reason why that was a good asset is that they saw value in the uplift of cash flow, and if they're a cash buyer, that's a good thing because there's no leverage against it. So, 100%. if you're able to get the uplift of value, and value for them is, yes, there's a capital value, but it's how do I get greater utility from the money I plug into it to get the return that I want through a higher rent on it. So you're seeing a lot of that at the moment, a lot of people changing the mechanisms for looking for value. And if you can identify undervalued assets by way of rent and lift that rent up is where you can really change the cash contribution that a property can deliver to you. So it's a really good example. That not premeditated, but I'm happy that you actually gave me a response like that rather than most buyers agents would be. I found this property at X and it's really worth Y, and therefore that's where the value is. That's good. That's what good buyers agents do.
Absolutely.
But there's other bits to it as well, right? And that probably lends itself to different parts of the phases that people operate within because you want your portfolio performing as best as you can on capital uplift and also the yield that it generates. This idea of the different phases of property investment often gets overlooked, George, because I think people think, well, everyone knows that. But I know that at Smart Property Investment, I probably do it a fair bit. I mainly talk about the first real phase of it, and that is sort of the acquisition phase, but also the consolidation phase. And consolidation can sometimes be a moment in time you go back to acquisition. There's sort of this shifting sands between going from acquisition to consolidation, and everyone will go through that at a point in time to a point where you just want to start getting into retirement. And retirement means different things for different people. Some people retire with a portfolio outside of super. Some people retire with a portfolio inside of super. It works differently. But let's start off, George, at a sort of the acquisition phase. This is mum and dad investors who are the backbone of property investing in Australia. They hold the majority of rentable assets in Australia, and we hear them sort of spoken about all the time. The mum and dad investors, the nurses, the police people, the firemen, the teachers, the public servants who all own property. When you're in that acquisition phase, and no doubt that's where you do a lot of the technical work as a buyer's agent, in terms of goal setting, how do people do that really well, do you think?
So I think the key to that is to be able to set SMART goals, I guess, which is obviously a phrase that we hear often, right? So to be able to sort of set something that you can measure and then take steps towards trying to achieve. So typically when I do sit down with my clients, we go through a 3-step process and that's a bit of a subsection of a wider property mastery framework where we have, but ultimately it's about assessing their financial position. So we find out about their income. There's going to be no surprises here. Their income, their expenses, their assets, liabilities. And then from there, we move on to what they want to achieve and by when. And it's interesting, I find that particular question is quite polarizing for most people, because if you're in front of someone in their acquisition phase, they're just getting started, but you're asking them what the end looks like. So if they don't know the answer to that, that's completely fine. We can help them find out what that is for them. It's not a one-size-fits-all approach, but we can ask some probing questions to help them figure out what the end would look like. And then third, I guess, once we know their journey, their timeline, we'll put together a plan to try and get them from where they are now to their desired destination.
And the acquisition bit's important because this is where you build your asset base. The hard thing with that is that when you say to someone starting out, they might only be in their 20s going, oh, where are you going to be in 40 years' time? They're going to, I don't know.
Yeah.
You know, I just want to invest in property because I know it's a good way to create wealth, which is okay, by the way. And having a plan to have a plan is sometimes okay as long as it doesn't force you to make poor buying decisions during the acquisition phase. And you hear this bandied around all the time, George, this idea that most Australian investors only own between 1 and 2 properties. One of the reasons why is that they buy the wrong properties first, which has sort of flow-on effects. That means that they're hamstrung for buying or fixing or resolving a problem in their portfolio into the future. So how do you interrogate that? Like, how do you have a discussion with someone? Because if you're going to use a buyer's agent, you need to accept that they're going to ask you a whole bunch of questions you might not be comfortable answering. But in order to get the outcomes you want, you need to actually be clear on this, and a good buyer's agent can help you identify the questions you need to ask and maybe just get you thinking about it. You might not have the answer immediately, but it's good to ask the questions, isn't it?
Absolutely, it is. And you're right, you won't necessarily have all the answers right away. I think it's very rare I come across someone who has done all the legwork, they know the background, they know everything, they're ready to go. If anything, most people don't have all the answers. And I guess for me, it's about making the clients realize that their position, their journey is different to the next person's or the person who came before them. And that's completely fine. There's nothing wrong with that at all. You know, someone in their 30s, as you said before, is going to be in a completely different position to someone in their 50s. So someone on a higher income with a strong cash flow is probably going to value a property that gives them greater level of growth and not so much of, you know, they won't place as much of an importance on cash flow. And then conversely, someone on a modest income will want a high yielding cash flow positive income with a lesser focus on growth. So it's important to sort of know that, you know, you sort of run your own race and you're not really competing against anyone. And then we set a plan to get you to where you want to be in line with, you know, your financial position, your goals, your aspirations. And to your point, you don't really want to go above your means either. So that the point of this isn't to put you in an uncomfortable position. It's about long-term wealth creation and allow you to live a lifestyle that you want to over the long term. But the intention definitely isn't to put you in a place where you're going to go into hardship because you've committed to this.
And that's the last place you want to be, because the worst thing as a property investor is that when you've got to sell off assets when you don't necessarily want to sell them off because of cash flow issues or rather structural concerns you have because you haven't done the right things at the right phases of the acquisition process. And one of the tough things about this phase, this acquisition phase, is that you don't always know where you're going to finish. So you need to have an approach with the acquisition phase that it may be cyclical. And cyclical being you might buy hard and buy a number of assets to a point where you can't buy anymore because the bank won't lend you any more money.
Yes.
Most people find themselves in that spot. Then something needs to happen in order for you to start acquiring again. The inverse of that is you might be on a really good acquisition phase and then something happens which means that you've got to stop buying, and that might be you lose your job or you change your jobs or you may start having a family that you weren't planning and preparing for. So these things are very cyclical. So you're going to have an appreciation for the construct, George, of how it works. And this is this shift from acquisition consolidation. You must see already in your business people who have gone through that a number of times where they've got to restart the acquisition process again and again and again.
Absolutely. It's all part of the ebb and flow. And the important thing, I guess, especially if you're starting out and building a foundation, is to be able to recognize those indicators. And you may not know that at the outset. No one really comes into it knowing everything. But, you know, surrounding yourself with the right caliber of professionals definitely helps. So, for instance, at the very beginning, a very worthwhile exercise is talking to a property-savvy mortgage broker who understands how to structure things. So if you're buying solo or if there's two of you buying the property, things you need to consider are you going to buy in one person's name? Are you going to buy in both? Are you going to buy in an investment vehicle like a trust? And you won't know that, right? Because you've just started a year or two into your journey. But the right people around you can definitely guide you, because you're right, you are going to hit that ceiling. We're going to hit a speed bump, especially when we move into the consolidation phase or just before. And it's about sort of laying plans to be able to overcome that.
Yeah, and you need to have a sense of comfort with being uncomfortable when it comes to property investment, and understanding how you're going to ebb and flow, to use your term, through these different phases. A lot of stuff you can't control. And you might be on an ambitious acquisition process, and there you are in April 2022 thinking interest rates aren't going to go up until 2024 is what the Reserve Governor told us at that point in time. And your buying plans may have come to an abrupt halt. Now, you need to remember what you've bought previously with an eye towards the future. If things do change and stop and you've bought the wrong assets that don't really lend itself to a changed environment that you have no control over, you have to respond and react to that, which forces people into a period of consolidation for a period of time. And most people, to be fair, in property investment are in a consolidation phase. They're not doing much. They're just tinkering. We'll have a chat about what to do specifically in that phase to get the best outcome from it. But when you're buying assets in this acquisition phase, and we're talking primarily around property, things happen in unison around this in other asset classes, but this acquisition process in property, what's the sort of the key fundamentals, do you think, to ensure that you are spreading risk, that you're inherently preparing yourself to maintain an acquisition process to your control? What have you seen works really well?
Absolutely. So I think the people who heed the advice of the professionals know that diversification is a fundamental when it comes to this, and it's almost risk management 101. So typically when we talk about diversification, the thing that comes to mind is the geographical diversification, but that's not what I'm talking about at this point. So it's more around diversifying in the types of assets we invest in. So we want to invest in assets that will grow not only naturally, but assets that will allow us to manufacture that growth as well. So when we do hit that bit of a speed bump, or we can see it coming around the corner, we're investing in assets that allow us to grow the cash flow it's generating for us as well, and grow the capital value of it. So a freestanding house, for instance, you could add a granny flat to generate more cash flow. You could look at sort of subdividing, and you can also look at any small-scale developments as well that are suitable for that particular asset. And it's not to say that that's something everyone needs to do, but to your point, it's giving us options. And when it is a rainy day and we need to pull those levers, then we'll be in a much better place for it.
Yeah, optionality is critical, and I know a lot of investors who put that front and centre of their buying, their acquiring process. And you're talking about the opportunity to manufacture equity there, George. So buying a good, and one of the other examples uses the opportunity to manufacture cash flow, right? Both work side by side, but manufacturing equity is not just finding something you think is under market value and getting the natural inherent uplift for it. It's identifying stuff which might not be consistent with other areas of the market where you can do a cost-effective renovation and lift it up a rung. But the point being also is it's the optionality around having the ability to subdivide or build a granny flat or a small-scale development. You might not necessarily do it yourself, but the fact that you have the optionality to do that gives that asset a different sense of appeal should you choose to sell it or shuffle it, exit and move it on. So it gives you the potential for the capital growth in the future should you choose to actually offload that asset. So this is so important when it comes to identifying assets during the accumulation phase, isn't it?
Absolutely, it's critical, because I think it really is an area where people do get caught up, and you touched on at the very beginning around sort of investors having sort of the one or two properties, but having these properties in your portfolio as your cornerstone foundational properties where you do have the option. You don't necessarily have to pull it. You could go your whole life not pulling that lever. But if you decide, hey, property investing is for me and I can see it working and getting me closer to those goals, it's nice to have that lever to pull when the time comes.
Yeah, It's nice. And again, it's an old adage, you make your money when you buy a property rather than you sell it. So if you're buying the optionality for growth or for someone else to see greater value in an asset, you're going to do well out of it. And it helps you through that consolidation phase then as well, because it helps shape the way in which you go to construct that. And again, a phase is connected with the length of time, and the length of time being unique to each individual property investor. And we'll chat about the consolidation phase. The consolidation phase, we've spoken about this, you go in and out of consolidation depending on maybe not through choice, but through market conditions, maybe not through choice, but by government intervention, maybe not through choice, but your ability to secure funding, not through choice, because there's a war in Ukraine and supply chain constraints are pushing up inflation. There's a lot of things you can't control in property investment, but what you can control is your attitude towards moving and manoeuvring within the market that you operate within. So some people have a more linear approach to property investment where they have an accumulation phase, a consolidation phase, and then a retirement phase. I don't know many people who have done that. Everyone I know who's invested in properties had to stop for a period of time to stop and smell the roses and do stuff. Ourselves included in Smart Property Investment, we've gone years without buying property where we're just tinkering with the portfolio over that period. What's your view sort of for advanced investors, this consolidation phase? What does it look like, George?
So it's very much around looking at the portfolio you've got and trying to make it more efficient. And I completely agree. I think that linear line is, not many walk that path. And it almost sort of forces us to become active investors, and active not in terms of acquisition, but active in terms of monitoring our portfolio. So that age-old adage of set and forget type of investment, I really don't subscribe to that theory when it comes to investing in property. I think you need to be active. So that being able to sort of transition between the acquisition phase and the consolidation phase almost forces us to do that. But typically in this phase, we are working with sort of mum and dad investors who have had some runs on the board. They've been at it for a few years. They're ready to sort of take things to the next level, or even business owners, right, with a fairly strong cash flow. So typically it's about managing the LVR in this space and having a review of your assets and making sure they're performing optimally. So we want to be able to have assets that have more than one income stream, or the potential to have more than one income stream, like we touched on a moment ago. And it's really about tightening things up, identifying any poor performers, as you alluded to earlier, and laying plans to try and correct those and bring them into line.
Yeah, absolutely. And the best investors, I'd like to think that I sort of fall into this equation. They always have a foot in the acquisition phase and the consolidation phase. It's symbiotic. It happens simultaneously all of the time. If you get the consolidation phase right, unless you're really at the back end of your portfolio, if you've got the consolidation phase right and you can jump in and out of effectively, you've always got an eye towards acquisition. Now, that might sound sort of counter-cyclical, counterintuitive, but if you're consolidating for me, and you must see it, George, is always having an eye on your mortgage. Make sure your cash position is the most effective, because you've got the best mortgage for any given property at any given time. And if you're forgetting about that, you're going to lose your way, and you're probably going to stay in consolidation forever and move into retirement without going back into acquisition. But the point you made, I think, is key. Is property is not a passive investment. It's a proactive approach, particularly in consolidation, because if you set and forget on your property portfolio, you're probably not getting the best outcomes in terms of rent. You're not getting the best outcomes in terms of mortgages. You're not getting the best outcomes in terms of managing effectively your property manager. And you need to manage your property manager. They manage your property. You need to manage them. And if you're not on them, you might not be getting the best outcome ever. And this is particularly for advanced investors. If you've got one property, consolidation is pretty easy. When you end up with a multiple property, and you must know, and I know people with many, many properties, it's a full-time business, right?
Absolutely. It's very demanding, and you do, even though you're outsourcing things to a property manager or other professionals, you do need to stay on top of it. Like I said a moment ago, you can't set and forget. Especially in economic climates like we're in at the moment, we typically focus on how can I get the portfolio to generate more cash flow or more revenue. That's one side of the equation. I guess there are, your holding costs, your expenses, your PM fees, your home loan rates. So it's those things that you need to stay on top of as well, because yes, looking at the income and increasing, that's great. but there's also a benefit to be had from decreasing your operating expenses of the portfolio.
Yeah, a lot of people forget this bit, right?
Yeah, and it's easy to, right? So, yeah, but I think it's good practice to, to write that down and check it regularly, whether you're going to review your things quarterly, 6 monthly, annually. It's always important to keep an eye on the expenses because market conditions change, both, on the revenue side and the expense side. And if you're going to run an efficient portfolio and try and, accumulate more, as you said, even if you are in the consolidation phase and traverse between acquisition consolidation, then you need to manage both sides, the income and the expenses.
Yeah, that's the right word, to traverse between the two of them. And again, it's what smart investors do. If you put the time, energy and effort, if you're not, just because you're not buying doesn't mean that you're not a property investor. If you've got real estate assets, so for the purpose of investment, you are a property investor. And most of your time as a property investor is going to be in this consolidation phase. It's just the realities of it, intermixed with sudden bursts of activity, which is going to be an acquisition phase, right? And sometimes a consolidation phase doesn't mean finessing your portfolio and working more effectively on rents and mortgages and property managers. Sometimes it could be selling assets, right, to actually get you to a point where you can go down through acquisition phase again. And again, it's a cyclical nature of property investing, and a lot of people think that you buy property just to hold it. Like, it's okay to trade property, right? You don't go broke taking a profit.
Very much so, very much so. And it all goes back to that strategy that you set out to start with, right? So if offloading a property is going to get you closer to that end goal, then that's what you need to do. So there's nothing wrong with sort of buying and holding, but you can trade property, you can upgrade, and if that's going to get you towards the end of your goal to get to the finish line, then that's definitely something you need to consider doing.
Yeah, and all this is this acquisition, consolidation, retirement. There's a lot of tactical, right? Got to get back to the strategic stuff, and that's the goal setting. This is like what you want to achieve, and how do you go about doing it? Well, you embrace these phases that you're going to find yourself in as a property investor. Do you like the goal setting side of things with working with clients? Is that the bit that you get a lot of satisfaction out of it? I imagine that's sort of connected with why you go about doing what you're doing as a buyer's agent.
Very much so, and I think it's interesting sort of seeing a client or a prospective client, come on to having a discussion, and they may have a different approach or they had something different in mind. But once we sort of talk through around that strategic approach and setting smart goals and a plan and a timeline, they realise that there's more to it than just buying a place and calling it an investment property. So that part, seeing a plan, is really when prospects or even clients realise, hey, there's value in what we're offering. So it's definitely rewarding.
Yeah. Have you found certain types of clients attracted to you as a buyer's advocacy? Is there any sort of commonality with the people who you're working for or with?
To be honest, not so much, but I find the sorts of clients that do come my way are ones that want to have a conversation, they want to understand. I think the general sort of feedback I've had is they feel that I'm not really sales or target orientated, which is probably a true assessment, I'd say. So they don't feel pressured. They don't feel that if they don't sign up at the end of the call, they're never going to hear from us again. So I'm attracting the sorts of clients who want to sort of feel their way around in the dark, so to speak, before they commit. And that works fine as well.
And you're happy operating that way? It sounds like you like operating that way.
Yeah, because I think it gives them comfort, right? It gives them, for me, if I'm a consumer with anything, I want comfort that my well-earned money or hard-earned money is going to get me the outcome I want. So if I need to have a conversation or an extra one to get that comfort, then so be it. So I try and offer that to my clients as well. And it's not sort of everyone. You've got people who have done their due diligence, they've done their research, they've been following me for a while, they know how I talk, how I think, my approach. They come back. Sorry, they approach me, and they're ready to go. I had one fellow tell me a few weeks ago, "Don't do the sales pitch. I've been following you for so many months. You're preaching to the converted." So it's very much sort of being able to adjust my approach depending to what the client needs.
Which bit of the job do you like the most? Is it finding new clients that you can help, or is it finding properties for those clients? Changes by the day.
Yeah, it changes by the day. And it's sort of different, right? Because different clients have different ways they want to be engaged in and communicated to. So some want to be more hands-on, and a key takeaway, some have specifically said, is they want to learn why we're making the recommendations and the decisions we are to go with a particular asset or to leave a particular asset behind. So I quite enjoy that coaching aspect. And at the end of it, when they realise that their investment in our business has been a worthwhile investment, that's rewarding, because they're referring a friend, a family, and what have you, and they're talking about coming back for the next one. So that part's really enjoyable, because it's it's the proof in the pudding.
Yeah, and this is the point. You invest a lot of time, energy, and effort, not only in relationships as a property investor, but in the inherent assets that you're buying, and how that sort of all comes together to be a portfolio. And we sort of spoke, you go from acquisition to consolidation and back again and around. It's a point in time for all investors where they're going to end this retirement phase. This is like the goal setting stuff. At a point in time, you want to be able to derive some sort of either equity event, capital event, or some sort of accelerated income event that provides retirement savings. There's lots of different ways in which people find themselves in a retirement phase. For a lot of people, investing in property outside of super has different equations or different outcomes for people who invest inside of super. And I do both. I have assets inside and outside of self-managed super fund. Pros and cons with self-managed super funds. Outside the scope of this, too detailed to this particular podcast. But for those people in retirement phase, specifically as SMSF investors, what do you see the benefits of that, George?
So I guess there are a few considerations, even sort of, making that leap too. So we want to know, or the investor wants to know that form of investment is right for them, right? So typically where, even though I've got the financial planning understanding, we don't provide direct advice in that space. So it's really underpinned by a statement of advice that's generated by a financial planner or a strategic partner. But the benefits are basically, if you're someone in your 50s who is approaching sort of their retirement phase, you may have 10, 15 years ahead of you in the workforce still. And at that point, you may consider investing in property through your SMSF. You still have 2, potentially 3 property cycles to benefit from. And the benefit we're talking about is compound growth. So all of a sudden, investing in property at that point could become a very attractive consideration, because it is relatively long-term still. And there are a few cycles there that you could benefit from as well.
It's an interesting point you make. A retirement phase isn't like, bang, you hit a retirement phase. Retirement phase is planning for that phase. And this could be, you're planning for it in your acquisition phase and your consolidation phase. It's a point of saying, okay, at a point in time, the portfolio, the basic rationale for the portfolio changes to being, I'm going to draw on the asset that I've created. And you might be thinking that 10, 15, 20 years ahead of it. I think about my portfolio and how I will derive value from that in time. And that's a retirement phase, but I'm a long, long way away from that. So inside or outside of super, I think the point being you're going to get different outcomes if you invest in property inside of a self-managed super fund rather than outside. There's different ways in which you can realise the value of your real estate assets inside of self-managed super. What's your views on self-managed super fund? You like it as a tool for creating wealth?
I think I'm
speaking generally. We're not providing any investment advice here.
Absolutely. In general terms, and being a little biased, given I'm gravitated towards property, I do like it. I think there's definitely merit in considering that asset class through your self-managed super fund. The reason is, again, there's that long-term growth that's going to come into play, but also typically we want to increase the cash buffer in our superannuation funds. I guess that's sort of the goal at the end of the day. The growth is good, but you want to be able to increase your cash buffer, right? So for when you eventually slow things down. With property, even in the current market, though they're difficult to find, you can find positively geared properties. And the benefit of that is if it's a couple, for instance, who have set up an SMSF, not only do you have your PAYG super contributions that are coming through concessionally, but you also have the rental income coming in. So, and over a 10, 15-year window, it's quite a bit of cash there that you'd end up with in surplus.
Yeah, and that's a good point. And it's going to sound really basic, but people get a lot confused with it. Every property can be cash flow positive. It just depends how much debt you have against it. And the propensity that you see for people investing inside of super is that you often see more cash flow positive properties because of the cash contributions, but also LVR levels are sometimes different inside of self-managed super as well. So if you want your properties to be cash flow positive, you just need to have less debt on them. And you can do that in a number of different ways. One is through offsets, which means you pay less interest on the money you have offsetting it, which can sort of move in and out of positively or cash flow positive, or you just take chunks out of the principal component of it. It's a real quick way to become cash flow positive, but that not necessarily be the strategy you want. And again, this is all going to be dependent on what you're doing in any of these particular phases. George, mate, I've really enjoyed it. I've been going for nearly three quarters of an hour. That's flown by. Happy to chat about these sort of logic of these phases with people. What's the best way to get a hold of you, mate?
So the easiest way is to just head to our website, which is at jameschase.com.au, or follow us on our social media channels at James Chase Buyers Advocacy.
Okay, and that's CHASE.
Correct.
Okay, James. What is it? James Chase.
jameschase.com.au.
You got the URL, jameschase.com.au.
I did, funnily enough.
Were you surprised when you looked it up?
Very surprised, because in the beginning I had different things and they were all gone, but that was available.
James Chase. When you saw it, you went, that's it, it's a sign.
Instantly.
Yeah. Any logic behind James Chase?
So it's actually named after our two boys, so Hunter James and Jordan Chase. So for me, it's a bit of a built-in reminder as to why I do what I do. That's
nice. So every time you say it, you remind your kids, you've got to get it right then, right?
Absolutely. No room for errors when it comes to that.
No. Well, no, mate, George, I've really enjoyed our meeting. It's nice to have that common connection with our accountant. But keep at it, mate. I think, Australia has a very bright future ahead of it with property investors leaning on the capabilities of buyers agents and as a growing industry. And I think you'll see a lot of growth into the future. So you see a lot of real estate agents ending up in property advocacy. I think they like it more than being on the sales side, which is a good thing. But go and check out George if you want to more information to chat through. We've really only just touched on some of those different phases and different people inside those phases. An acquisition phase for a mum and dad investor is very different than an acquisition phase for someone who has greater capacity with bigger incomes and at a different age of their life and different attitudes to risk. So again, your property journey is completely unique to you. There's some clues about how it might play out based on what's happened to other people in the past, but you need to have your own approach and you need to make sure you do what's right for you. And tune into the Smart Property Investment Show because we cover all this stuff off. Remember to check out all the other podcasts we have. You can find us smartpropertyinvestment.com.au, social media, Smart Property HQ. You'll find us. And if you're tuning on the internet, watching the videos, hope you enjoyed as well. People chatting. People enjoy it for some reason. It's pretty cool. I watch a lot of podcasts myself. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.